If you're thinking about buying down your interest rate on your next mortgage, but you haven't looked at the actual math, then you might be missing out on the whole thing. So in today's video, I'm going to be talking about discount points, how they work, and when you should consider doing them or not. Oh, and by the way, comment save, the word save down below, and I will send you my free mortgage cheat sheet, some really cool tips that I've compiled over the last, 25 years of doing this, and it should help you out quite a bit. My name's Darren Rhodes. I'm with True Partner Home Loans and been helping fellow Utahns just like you for, like I said, 25 years get the very best mortgage possible. Okay, discount points. How do these things work, and how do you know if it's the right situation for you? So this is how it typically happens. You start going through the application on your mortgage, and you're given an offer. Hey, listen, if you are able, this is arbitrary, by the way, if you are to put $3,000 down extra, then we can lower your rate by 0.25%. And you think to yourself, ooh, well, that's not a bad deal, possibly. Or you might say to yourself, I can't spend another dime. I wish I could get a lower rate, but I'm totally tapped out. So which is right for you? Well, there's 3 steps to know if your discount points or buying down your rate is actually worth it. So the first thing is to know what you're actually buying. When you walk into a store and you're shelling out your hard-earned cash, you want to know what you're getting in exchange for that money, right? Well, when you are buying down your rate or paying for discount points, as it's called, you are giving the lender money up front in exchange for a rate that is lower than would be typical. So that's what you're offering for that money. Okay, so then number 2, how do you know if it's worth it? Well, this is the most important part of the whole game, and that's called the recovery time. You simply take how much money you're spending up front and you divide it by the monthly savings. So simply put, let's say you do spend that $3,000 and it saves you $300 a month. Well, $3,000 divided by 300 would be a 10-month recovery time. So after month 10 in that scenario, you would be in the clear and saving even more money. Okay, so we always look at these recovery times, and sometimes they're really long, sometimes they're 5 years, sometimes they're really short. But we always want to look at the recovery times to make sure that the math lines up just perfectly. Now, that brings us to step number 3 is we want to compare that recovery time with how long you're going to hold that mortgage. Because if your mortgage is going to be held for a very long time, then sometimes it does make sense to put a little more money up front and get a lower rate. Or if you think that you might be out of this mortgage before the recovery time, well, you don't want to waste your money and throw it out by not even hitting the recovery time before you sell or refinance.